You have been lied to. And that lie is costing you tens to hundreds of thousands of euros. The idea that you need 10,000 euros or 50,000 euros or any huge lump sum to start investing, that it's only for the already rich, that's a myth designed to keep you from building wealth. And today, we're not just breaking that lie, we're absolutely obliterating it. Just a quick note, I'm not a financial advisor, this video is not financial advice. I'm going to show you step by step how to start building an investment portfolio that will generate wealth, even if you have just $100 or even less. And if you're ready to stop feeling broke and actually start making your money work for you, stick around. This is the 2026 reality check you need. So first, who benefits from this lie and why does it keep sticking around? For decades, investing was genuinely gatekept. Traditional banks and old school brokers, they thrived on exclusivity. Of course, that meant insane fees, like $20 per trade, hefty minimum balances, mountains of paperwork, and you absolutely needed a guy just to buy even a single share. They intentionally made it complex. And now, fast forward to today, and you've still got gurus and experts echoing the same sentiment that if you don't have 10,000 or something, you shouldn't even bother to start. They claim it's not worth it. And it feels logical, right? I mean, what difference is $100 gonna make? But that is precisely the trap. The true gatekeepers today aren't just high fees anymore. They are the fear of starting small. It's the misinformation that prevents action. And here's the 2026 reality check. With modern, fee-friendly neo-brokers and, investment apps, you can literally start with $100, $50, $10. There are no real minimums, no complicated paperwork, and absolutely no excuses. This myth isn't harmless. It's actively harming your future. It's stopping you from engaging with the most powerful tool you have, compound interest. And the longer you wait, the more it costs you. So what's the actual path to wealth for us normal people? In the end, it's the simple, humble and boring ETF. It's truly the set it and forget it strategy. Think of an index fund or an ETF as a basket with hundreds or even thousands of companies in it. And instead of trying to pick a single winner, you just take a small slice of all of them. Basically, you're buying a piece of the entire market. This widespread of an ETF means that they are, for one, extremely diversified. If one company struggles, you still have hundreds of others. They are, in the long term, a low risk, because compared to betting on a single stock, you have countless of them. You're betting on the global economy, which historically always trends upwards. And ETFs are historically profitable. We're talking about average returns of 7 to 10%. And even the lowballing conservative 7%. It's still a pretty damn respectable number if you ask me. And the absolute best part of that in 2026, especially in Europe, modern investment apps like Trade Republic, Trading 212 or Scalable Capital have entirely destroyed the entry hurdle. They have completely democratized this because they allow you to buy fractional shares. And it's not nearly as complicated as you might think. If an ETF share costs $400, you don't actually need 400. Even if you just have 100, you can invest your 100 and buy a quarter of one share, a fraction of a share. And right here you see just how simple it is. Open the app, search for an ETF you're interested in, and with just a few taps, you can invest your $100. And notice the extremely low or even zero fees. That is critical. And a pro tip for automation and maximum laziness, set up a monthly savings plan. Automate 50 euros, 100 euros or however much you can afford. Automate it directly from your paycheck into your savings plan. This is called dollar cost averaging, and it will in the long term save you the trouble of trying to time the market. You don't need to be a finance genius or constantly check charts. You just need consistent investing and time. That is the real magic formula. Alright, this is where the old lie completely falters. Let's hit you with the numbers, because your aha moment is right around the corner. Imagine you're 20. You decide to invest just $100 a month, but consistently. What is $100 a month? That's what, 2-3 times takeout, some coffee. Maybe you even just have that money laying around because you didn't want to spend it but didn't know what to do with it. A small sacrifice, right? Let's say you start with 0. We expect the average return rate of an broad market fund of 7%. And we use monthly compounding. And you make $100 at the beginning of each month. Considering 10 years, your investment would be 12,000. But if you let it grow, after 10 years, you're at 17,400. Pretty solid number. If instead of 10 years, you wait 20, then even though you only entered 24,000, your investments will have grown to 52,400. That almost doubled. Your interest itself already is more than your contributions by over $4,000. If you wait 30 years, you have entered 36,000, which is a lot of money. But due to the long time, the interest you've gained is almost 3 times that, with 86,000. Instead of having 36,000 lying around, your money shot up to 122,000. And I know all of this is dollars, but let's be honest, it's just as simple, it doesn't matter. And after 40 years, with a contribution of 48,000, your money shot up to 264,000. You've gained more than 5 times your own investment in interest. And 40 years is a long time, but is $100 a month really that much? I mean, with 260,000, you can almost retire on that. Just look at that curve. The blue is the money you put in. Can you see how much the green shoots up? Because that is the interest compounding on itself. Because you gain interest on interest on interest. The longer it goes, the more you gain. That right there is the real magic of starting early. Compound interest isn't just the interest on your money, it's the interest on your interest. It does the heavy lifting, especially in those later years. Now here's the kicker. What if you listened to those myths? What if instead of 40 years, you only did 30 years, but with a starting amount of 10,000? Although you would still have a solid 200,000, you would have lost 40,000 due to waiting. And of course that's all entirely ignoring inflation and the like. I mean, the difference of 40,000 is staggering, isn't it? You would potentially sacrifice hundreds of thousands of euros just because you believed you needed a huge sum to start. Now, real talk. Past performance isn't a promise of future performance. And of course, markets go down sometimes. But history so far has shown if you hold tight, it will go upwards. And don't forget, these numbers are all just $100. If you have a career, you're likely to move upwards and eventually earn more money. So would you in 30 years still just put in $100 a month, even though your salary, I don't know, tripled? Just some food for thought. The bottom line is crystal clear. The 10,000 euro investing myth isn't just dead. It was never true to begin with. You have the power to start building real wealth today, right now, with whatever you have. $100, 50, even just 1 in some cases. So stop letting misinformation block your financial future. Get that incredible power of compound interest and let it work for you. And also smash that subscribe button for more no BS finance info and tips. Stay smart, build your wealth, and stop being the bank's favorite customer.